We were just discussing that though the credit sphere has changed a lot. So perhaps you can give us an idea of where we stand now.
Yeah, I think you've gone through a decade of low interest rates, which has seen banks retract dramatically in Europe away from non-investment grade financing and the growth of private markets in the European sector. And I think the other big change that's gone on is what are people investing in today? And I think from an industrial point of view, we've seen a huge move because of technology and healthcare into outsourced business services, healthcare, outsourced technology, e-commerce, and areas of the new industry that's growing dramatically and quickly across Europe. So I think it's a really exciting time.
But currently, right at that time, we also are at a very exciting time for debt markets as such. We have a lot of volatility because nobody really can see what central banks are going to do in terms of interest rate given high inflation. So how is that a concern to you and your funds?
Yeah, I think, I ran a large bond trading businesses, prior to setting up Pemberton, and I think public markets tend to react or overreact when we start to have periods of uncertainty. And so therefore you've seen some very sharp movements in interest rates as investors try to work out how far interest rates will move and when will they move. I think the nice part about being in the private markets is that volatility really isn't in private markets. We've been very stable. Obviously we had the downturn in COVID, where we were very focused on corporate performance and liquidity in companies, as many of them went through periods of shutdown. But the really, I think, reassuring part for investors is those companies came through that process very strongly. They've moved back into earnings, which is either at pre-COVID, and in some cases above pre-COVID levels. So you've got quite a separation between the volatility in public markets and the stability in private markets over the last 12 months.
What do you think is more attractive, or the most attractive markets for private debt currently?
I think Europe is the most attractive market. I mean, the US really moved into private lending in the late 90s and early 2000s. You have had a proliferation of managers in the US market. If you come into Europe, Europe is very early stage in the private market development, but it also matches up at a time when you're seeing demographic changes. So through the creation of the euro, you're now seeing sector consolidation in Europe. And so you have lots of very attractive mid-market companies who are going to be consolidated into much larger players supporting either bigger conglomerate groups or different industries. We're in the very early stage of that sector consolidation, and the reason private equity has been so active is that many of those companies are run by executives who were in their 30s or 40s when the euro arrived. 20 years on, they're now in their 50s and 60s, and they're thinking about possibly selling their business, and that creates the opportunity set for that sector consolidation.
But are you also concerned about more scrutiny from the regulator? Because I just spoke to Frank Elderson from the ECB yesterday about the topic that, of course, they're looking at the credit market, and which is growing, the private credit market, and they are concerned that they don't have any sway over it.
Yeah, I think regulators always are going to be focused on new parts of the industry as they grow, but I think there's two, I would say, very, very clear methods that it's been regulated today. Firstly is the structure of the AIFMs in Luxembourg or Dublin or the UK means that the AIFM regulators are putting very, very significant scrutiny on the actual managers themselves. But we also are largely working with large insurance companies and pension plans, and they require us to give them tremendous transparency around the actual underlying assets we have inside the portfolios. So I think both of those create a check and balance already. Clearly, the regulators will continue to think, is there any further regulation that they need? But I think the industry today has shown, coming through COVID, it's very well managed, it's very diversified, it's very different to banks because we have 7-year money matching our loans. When I was in the banking industry, we were using overnight deposits to fund long-term loans, and it's a very different business model.